Welcome back to Explain the Charts, where we provide the context you need for the moves you see. Today is March 23, 2026, and we are looking at a market dominated by headlines from the Middle East. Geopolitical tensions involving Iran have escalated significantly, leading to a massive flight to safety across all major asset classes. The US dollar has been a primary beneficiary of this risk-off sentiment, strengthening against most peers. However, the Swiss franc is also traditionally a safe haven, creating a unique tug-of-war in the USDCHF pair. Compounding this is the oil market, where Brent crude has surged past $100 per barrel. High oil prices are raising stagflation concerns globally, particularly in Europe and the UK. The Federal Reserve recently held interest rates steady in the 3.5 to 3.75% range. Federal Reserve official Waller has indicated that he expects inflation to cool later in the year, but market participants remain cautious. Meanwhile, the Swiss National Bank has held its rates at 0% and downgraded national growth forecasts to 1%. With the fundamental backdrop set, let's look at the daily chart to see how these events are translating into price action. Looking at the daily chart since the start of 2026, we see a clear bullish recovery from the January lows. The pair recently rallied more than 3.7% from its monthly low, but it has stalled at a major confluence zone. Specifically, the level near 0.7926 has acted as a brick wall for the bulls. This level represents the 2026 yearly open and the 61.8% Fibonacci retracement of the decline seen last November. We can see a clear rejection at this point, which aligns with the 200-day simple moving average. Daily momentum divergence is starting to emerge, suggesting that the current advance may be losing its traction. For a bullish continuation, we need to see a daily close above 0.7974, which is the 1.618% extension. Failure to break this resistance could lead to a deeper correction toward the 7740 support level. The market is currently wrestling with whether the USD's strength or the CHF's safe haven status will prevail. Notice the long upper wicks on the recent daily candles, indicating that sellers are defending the 0.7900 area aggressively. This technical setup suggests the market is waiting for a fresh catalyst to determine the next directional leg. Moving into the 1-hour time frame, we can see the choppiness that analysts have been reporting. The price action is currently sandwiched between short-term moving averages, reflecting the market's indecision. On March 18th, we saw a surge to 0.7908 following the Fed's steady rate decision. However, the rally was short-lived as traders digested the updated economic projections and the dissenting vote for a rate cut. There is a notable consolidation range forming between 0.7817 and 0.7922. A breakout strategy is likely the best approach here, waiting for a definitive hourly close outside this range. Support is currently holding near the 50-day exponential moving average on this time frame. Retail sentiment is almost perfectly balanced, with 50% long and 50% short positions. This balanced positioning often precedes a high volatility breakout once one side is forced to capitulate. Keep an eye on the volume spikes that occur during the European and US session overlaps. Correlating the spikes with news updates from the Strait of Hormuz will be vital for intraday traders. Zooming in further on the 15-minute chart, we can analyze the microtrends between March 18th and March 20th. During this period, the pair fluctuated wildly as safe haven demand hit the market in waves. We can see how the price struggled to sustain any momentum above 0.7900. Every attempt to push higher was met with immediate selling pressure, likely due to profit-taking and SNB intervention fears. Technical indicators on this shorter time frame show that the market has been frequently reaching oversold conditions on the stochastic RSI. The price is currently hovering around 0.7880, showing very little net change in the last 24 hours. Notice the small, tightly packed candles, which indicate a temporary contraction in volatility. This typically suggests that a significant move is brewing as the market awaits the next round of geopolitical news. If safe haven demand for the Swiss franc intensifies, we could see a quick drop to the 0.7850 support. Conversely, if the US dollar maintains its dominance due to the high interest rate differential, another test of 0.7900 is inevitable. Short-term traders should look for entries near the boundaries of this consolidation for low-risk setups. Let's recap the most important price levels as we look ahead to the rest of the week. Resistance stands firm at 0.7926, followed by a secondary target at 0.7974. On the downside, initial support is found at 0.7823, with a critical invalidation point at 0.7740. I believe a bullish continuation is 60% likely if we get a sustained breakout above the 200-day SMA. However, if the Middle East conflict enters a brutal April repricing phase, as some analysts suggest, we may see a breakdown. A breakdown below 0.7800 would reinforce a bearish outlook for the medium term. Monitor the upcoming U.S. construction spending and ADP employment changes for potential U.S. dollar volatility. Also, watch for any emergency economic meetings in the UK or Europe that could affect safe haven flows. In the long term, some forecasts suggest a decline towards 0.7055 if global tensions ease. For now, the pair remains in a constructive but fragile uptrend that requires a clear breakout to confirm the next leg. Thank you for watching Explain the Charts, and remember to trade with a plan. This video is for educational purposes only and does not constitute financial advice. Always perform your own thorough research before making any investment decisions in the Forex market.